3 ticks profit on a trade, stops at break even, and then you got that explosive move within the next few seconds, and that's your money made for the day. That's the flow trader's money done. You can see that's how the work has been carried out. It's a good trade. You went from a price of 43.5 to a high price of 46.5. You made 3 full points, $150 per contract, and you were finished within 1 minute and 1 minute 20 seconds. That's your day finished potentially as a floor trader. 1 minute 20 seconds. Oh, that's all right, Mike, isn't it? You don't mind those kind of days, you know. How long did you work today? You made well, 1 minute 20 seconds. Did you make any money? Yeah. On a 3 lot, I did $1,000. I'm in the wrong game, right? So you can see just how good some of these narratives can be if you start to pay close attention to them. Now, obviously, in the early diddles, the first banker trade was obviously a long trade. The first banker trade was a long trade. You can see that there was a surge to the upside. You can see the value was holding into that. In fact, the pullback here could have been a reasonable proposition for you to ride a second long into that for the squeeze. Did okay. As it came back down, you can see the third trade actually was also potentially a long trade as well. But obviously on the break off the long trade here, you can see the value is now dropping against you and you're meeting in the middle for an exit. From that point onwards, the value has now been exhausted. There is no trade, and you're now on the sidelines waiting for the next opportunity. The next opportunity was the test of the day low. You can see quite clearly the day low is obviously this price here. The value is in it. So you know that there's going to be an opportunity to buy the day low. There it is. There's the volume coming in. See the volume candle right there? So there's the volume buy against that value. That's absolutely genius. No trouble. And you can see that the takeaway from that trade, pretty good. Another big volume down candle, exactly the same kind of location for another buying opportunity. And again, another successful trade. Beautiful. And another buy trade. This one looks even better. But obviously, because we've now had 2 failed auctions, the probability at this stage is that you may well get a third, a problem auction, because of 2 failed auctions gives you what? Paycheck liquidity. 2 failed auctions always gives you paycheck liquidity. So on the third test, I generally don't buy above the market. I generally wait until we get the break for the paycheck. When we get the break for the paycheck, we've obviously lost some short-term value, and I've got to be really cautious about it. But if it can get a low enough price, it's obviously still very definitely a buy trade. So obviously when that market just gives you that tiny little turn up, that's where you should have bought into the trade at that point. Now you can obviously see the value that's in this trade already. There's very, very definitely macro buy value just now at this point. And that's what you're doing. And obviously what happened is you got this beautiful, ballistically brilliant buy side break off those low prints. Like an absolute boss, you've commanded the pit's presence and you've absolutely destroyed the S&P. Any questions about that trade? Is that pretty obvious? Pretty obvious, right? A failed auction twice sets up paycheck. Paycheck is a question we were asked yesterday. What is paycheck? And the answer is paycheck is what we all want as a commercial trader. We want that liquidity. So if we set up one bottom edge, it's only a level 2. It's not paycheck liquidity. If we set up 2 bottom edges, we start creating the conditions for commercials to actually, it's worth a commercial worthwhile, actually taking the price down and through the price. So when we look at paycheck, when the price comes down, comes back up, this is level 1. So there's only a small amount of liquidity here. When the price comes down and doesn't take out that level, now we've got paycheck starting to form. If the price again fails on the way up, there's a high probability now that it's worth my while as a commercial to actually sell here a little bit of business. It's worth my while selling there as a little bit of business because the number of stops that's below the bottom edge are getting bigger and bigger. At this stage, when the price leaves this area, the number of stops in volume terms might be this. Obviously, as the buyers come in, the number of stops get bigger because the number of stops coming in and that buyer is going to be small, but as the price goes up, the number of stops is going to get bigger in terms of volume, isn't it? Volume and range. As the price goes higher, the number of stops might get bigger. Now, obviously, if the price goes too high, what happens? What happens to the number of stops if the price goes too high? What happens to the number of stops if the price goes too high? Does the number of stops get bigger or smaller? The number of stops gets smaller, Rick. Can you explain why? Yeah, profit taking, right? Because obviously the buyers are going to start seeing the price coming back out, so the number of stops probably starts getting a little bit smaller. They don't disappear, and they'll probably now stay static as the price drops. Get it? And then obviously, as the price buys, what happens to the move? Well, obviously the number of stops increases again as the buyers come back in again. And as the price rises again, the number of stops again increases. Now, because we don't take out the highs, we never get to the situation where these guys relieve the positions. They don't take profits, right? So the number of stops keeps getting slightly bigger until ultimately the price starts to move back down again. So you can see what's happened to the number of stops below the market, right? Does that make sense? So obviously when we see that number of stops, it's worth my while taking a bit short here. It's worth my while taking a little bit of short here because there's this amount of selling below the bottom edge now for me to buy into. So obviously the idea is that we then run the stops, which are now significant. All of that selling comes in. Significant selling now comes in as the stops get sprung. And that's my buy trade. That's as a commercial, that's my buy trade in terms of size. So we're going to use that liquidity to now get that trade on the books. That is what's called paycheck. And obviously the idea there is that it's going to be significantly more than the amount of selling that's required to do the trade, right? Yeah, but there's no value. Nobody wants it, Miguel. There's no value. If there's a lot of buyers at the top edge here, I like the fact that there's lots of buyers up here because the market's bullish, right? The value is bullish. So I like the fact that there's buyers at higher prices. So I love the fact that there's paycheck at the top edge, right? Love the fact that there's buyers up here because if I want to take some profits, I need those buyers, right? So if I want to take some profits, I need to find a buyer at higher prices to take my profits against without pushing the price straight back down against me. So the more paycheck we have at the top edge, the better that we have as well. And that's how we start seeing the evolving storyline. Because when we see what the value is doing, that's the storyline right there, isn't it? Commercials trade value. Dealers trade hedges. If we've also got a hedge level developing against this, so much more the better. That adds to the selling. And it's all about that inventory again at bottom edges, isn't it? Into the bottom edge here on the S&P, one of the questions I suppose would be, was there any dealer hedging levels into the bottom edge of the S&P? Well, the answer to that question was no, not at the open. There wasn't specifically a dealer hedge that we had to be around, but there was on the Nasdaq. If you remember, we looked at the dealer levels. One of the dealer levels was 870 on the NQ futures. So if we look at the NQ futures, you'll see into the bottom edge, there's a lot of dealers. There's a lot of dealer selling maybe coming in here, isn't there? A big strike here and here. So there's a lot of dealer selling coming in those two locations. It's not on the S&P, but there is some on the NQs, and that provides additional selling in the indexes to take advantage of. And obviously the takeaway from that trade was perfect. Again, it's just the banker bet. But obviously based on the banker bet, based on the initial range, we now have our target price, whereas there's the opening range drive high right there, yeah? So there's the opening range drive high. I take it down to I very rarely ever take it down to the bottom print price, guys. I nearly always take it down to that last print level right there. You'll see me do this all the time. I take off the last trade. And obviously that gives me my target price range, which is here for the bond, for the equity open. And the takeaway from this has been the fact that the price traded literally to the tick to that box. And you can see exactly what happened. Everybody poured out the deal. And that was it. That was it. Your day was finished. Now, your day could have been finished on the open. Your day could have been finished during this accumulation. By the time you reach the top edge here, you've now traded for a total of 8 minutes and 16 seconds. And this is great for retail traders because they could actually just trade the opens, couldn't they? You could set yourself aside a half-hour period of time where you could say, right, I'm going to do the opens just like a floor trader. I'm going to do the opens, and if I've made my money for the day by the first half hour, so by 3 o'clock London time, I'm going to pack up and head off for the rest of the day. That's exactly what the successful floor traders did do. They became specialists in cash opens. They became specialists in momentum order flow, and they simply traded for the first half hour to an hour. They made their day's money, and then they left the rest of the day to the guys that never made any money, the guys that they lost in the first half hour or hour. They left them in the pits for the rest of the day trying to get their money back. It's a good way to make a living, boy, I tell you. Make sense, guys? First half hour, first 10 minutes, first whatever. If you want to get active, that's a good little looking chart right there. In terms of the value, it's just the banker's bet. Simply the banker's bet. I'm just looking at the order flow that's coming in the stock market versus the order flow that's coming in on the futures market. And it's a good way to deal because it's obviously a very, very, very safe. It's a very safe line because you don't get much of a divergence off these two lines. Very, very rare do you ever get a divergence on these. You can on the specialist line over a period of several days, but you very rarely get a divergence that isn't tradable on the banker bets. That's why it's called a banker bet, guys, because it really is a banker bet. You know, if you've got a divergence in this, it's almost a given that you're going to make money on it. Just like it did at the top edge. You can see what's just happened there. So you can see that we had a banker bet setting up at the top edge. There was a bit of divergence, short-term value, so you had to be careful, but that drop-off is significant as this price tested. Look, it would have been better if we'd ran the stops. That would have been brilliant, but there's too much value in it. Nobody's thinking the price is going to go through that top edge anymore. And it was pretty obvious that that was going to get a nice short trade away from those areas. A banker's bet is called a banker's bet for a reason. It's a banker. When you see them setting up, guys, and you've got a top or a bottom edge and you see some volume surging into it, guess what? It's time to get ill. It's time to get ill. We can see in terms of value, we can see that into these banker bets, you'll see all sorts of short-term and long-term values. This is a 1 second chart, by the way, guys. Remember that. This is a 1 second chart. So you're talking about rapid type stuff. You can see that when we hit into some of these higher levels, like 40 plus, and you've got a banker's bet, high probability with that divergence there, that's going to be a buy trade. The volume's increasing enough to get you into a long trade there, for example. Nice outcome. Very nice outcome. So you're obviously trying to put the long term and the short term. You can see into these banker bets here, there's a little bit of short term value divergence into this high, and guess what? Nice little outcome. Nice little outcome. along in the far right-hand edge of any chart, you'll see exactly what's happening most of the time. You can see there was a little bit of value in here initially. You can see there was a little bit of value developing down here. And obviously that's a sell, but obviously we've got a macro sell, but we have a top edge that would be even better if we could run up into that. And that top edge is brilliant. Short term, I don't like trading against this short term because that's going to be enough to push the price continually higher. I want to see that divergence. I actually want to see that short-term divergence lining up with a long-term divergence for the short trade to work. So we start watching for that short-term divergence. At the moment, we don't have it. So that isn't a trade for me just yet. I want to see that short-term divergence. Now the trade's short-term diverging. That's just picked up a little buy there. So we've got to be careful with that. But it's got a little buy back into it. So we're not seeing that short-term divergence quite yet. But you can see that there may well be a sell starting to come in, but that's still ticking up, so it's not a sell yet. Not a sell yet, still 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 not a sell yet. You pull away your sell limits, let the price go up short term, let the price go up, and as soon as that down ticks, you start trying to work your prices. Now, obviously, we're also at the 41.50 level, which you must know. We're at the 41.50, so there is a huge amount of liquidity at this price. And there's always going to be a big desire to run the stops and get that liquidity. Well, just as I was talking about it, they go in and run the stops, got that liquidity. And obviously on a macro scale basis, that's exactly what you're looking for. Knowing that that was probably going to happen with a short-term value, you waited patiently above the 50s. And then you smashed into the short trade. And then that's taken away beautifully as a little scalp sell. Crazy good? Not really. Just pretty good, pretty common sense if you ask me, guys. Pretty much common sense.